From our world headquarters in New York, Bloomberg Surveillance. Don't forget, we're out on iTunes under Business and Business News. And, of course, at Bloomberg.com. Look for the Bloomberg Surveillance podcast. Ken's Bloomberg, the first word, as well as Bloomberg on the economy. Julia Coronado of BNP, good morning.
Good morning.
How big a deal is this jobs report tomorrow? If we have John Riding's economic recovery to 2%, what's your 2010 call at BNP?
Well, we see 2010 being a year of subpar growth. So
two-ish?
About two-ish, yeah.
Okay, fine. So you both agree on 2% growth. Can you have an economic recovery and have a difficult job market as well, or do you just have to wait for the job economy to come along?
Well, we've had two jobless recoveries the last two recessions, and I think that's exactly what we're going to see this time around. It's a very deep hole that we have to dig out of. It means a bumpy recovery. It's not going to be smooth. It's not going to be V-shaped. But, yeah, we can grow as the economy can move forward just more slowly.
Do you agree with John that we've got to get to 400,000 on jobless claims to signal sort of all clear as a first optimism of the labor market?
Yeah, that's about the threshold we're looking for as an indication that things are really turning. Actually, initial claims have been sticking a little high. They came down quite a bit and then kind of got stuck in this range. So that's one of the key indicators we're looking for.
Our guest host, John Riding.
Well, I think those claims numbers came down a bit fast in July just because of the distortions related to the shifting of factory closures, because they all assumed that the auto workers weren't there in early July. So I'm not so sure this little stickiness is nothing more than, you know, we got the good news kind of a few weeks early, but we really need another 150,000 off these claims.
And Chris, we welcome Christy, camera girl. Christy, get over here and look at this chart, if you will. Here's a jobless claims coming up from 300,000, and then here's that 400,000 mark that John Riding and Julia Coronado are talking about, and then up we go, folks on radio, to 658,000, Ken, and then we've rolled over, and there's what John's talking about, those distortions, Ken, from auto production.
Well, Julia, the big number comes out tomorrow morning, and that's, of course, the unemployment rate for August. Economists in our survey see 9.5. That would be up from 9.4. And, of course, July was a big surprise because everybody thought it would go up, and it went down a tenth of a point. So what should we look for tomorrow morning?
Well, actually, so I think the tone of the report's going to be a little bit worse than what we saw in July. We're looking for 275 on payrolls. I think payrolls came down a little bit faster than claims would suggest, so we're looking for a little bit of backtracking there. Also, as you mentioned, the unemployment rate, we're looking for 9.6. And basically, yeah, it was a big surprise driven by labor force participation going down. That shouldn't continue.
And where does it peak?
We expect it to peak close to 11%, so we've got a long ways to go. And again, it will be initial claims that tells us how fast we're going to keep rising, and that's one of the key indicators we're watching.
This is kind of thing that sort of feeds on itself, right? I mean, consumers look at that number, the unemployment number going up, so they don't spend money, and because they don't spend money, the number goes up some more.
Well, I mean, I don't think most consumers are actually watching the unemployment rate. They just see jobs being lost around them. So this idea of, you know, smaller declines in job losses doesn't mean much to the average consumer. They just see a lot of uncertainty and possibilities of losing their jobs.
I want to change gears here. Every once in a while, you know, I get like 400,000 reports a day. John Riding sends them in by carrier pigeon, and they all come in and they're all great, and, you know, I'm honored that everybody sends me their reports. And then there's one that stands out like you hit your thumb with a hammer, the commercial real estate landmine. This is, I mean, we know it's bad. Ken and I have been following this for months. Your work here is absolutely shocking. What is the new of commercial real estate?
Well, the scary thing about that sector is that we are just, it's a very slow-moving train. So we're just starting to see, you know, the defaults, the bank failures that are resulting from the losses in that sector. These loans tend to have 5 to 10-year maturities, so as they come up for renewal, you've got banks and investors looking at a loan where the property's depreciated, the cash flows are down. At that point, the loss has to be taken, and we're seeing bank failures accelerate as a result.
What do you see at RDQ?
Well, the problem is commercial real estate is the one big remaining problem for the banks. And you can keep the Fed's balance sheet growing, and the TALF program is sort of focused on trying to get that commercial real estate debt rolling over. But the reality is you need to get people into jobs, because otherwise those offices are going to be empty. You're not going to get the cash flows, and banks are going to end up taking a lot of these buildings into essentially bank
and
possession.
Insurance companies too?
Absolutely.
Well, Julia, is this what, garden apartments in the Sun Belt, office buildings in the Midwest, shopping malls in Cali? It's just pretty much across the board?
It's across the board. It's the retail sector. It was the real estate development sector, office buildings, industrial properties. You know, every sector's been hit, and so we're seeing losses across industries.
Well, you know, you're right. We've been talking about this for a while, and there haven't been that many big numbers yet on commercial property. But one of the things that I guess we do know is this is a real problem for smaller regional banks. That the big guys learned their lesson back in the early 90s, the cities and the J.P. Morgan. So this is a little bit off the radar because it is smaller banks.
Yeah, it's been creeping onto the radar because of the FDIC issues, and I think that's where the headline risk comes from. It's not to say that the economy can't grow through all of this, but what it does mean is that the banking sector is going through lots of restructuring and lots of consolidation, and that means credit growth is going to be fairly impaired for a long time. And that's exactly what we saw post-savings and loan crisis. This is savings and loan crisis squared.
Yeah, that's a great way of putting it. I'm going to put that on Twitter. That was absolutely poetic, Julia.
S&L crisis squared.
Square. We can do cricket squared.
Yeah.
That would be even better. Let's get to the news. Where are we? Futures up 8.
Well, some of the other news you need from around the world this morning. California residents who fled wildfires have been allowed to return home to survey the damage. Firefighters are strengthening their efforts. The weather cooperating, less wind and more humidity today in the Los Angeles area. The death toll from the 7.0 magnitude earthquake that struck near the Indonesian island of Java yesterday rose to 57. President Obama will take a more direct role in the legislative fight over revamping health care. He'll make his case directly to lawmakers and the public next week by addressing a joint session of Congress. Bloomberg's John Bascom will have more on these stories in a few minutes. In sports, Federer and Serena Williams advance at the U.S. Open. And in baseball, same old story. Yankees win, Mets lose. Yankees winning streak now at 6 as they bid a fond farewell to the city of Baltimore.
We're Bloomberg Surveillance Worldwide, 7 to 10 a.m. We welcome all of you. I'm going to go out with this chart here. This is the bank index. For those of you on radio, this is the big rollover in the Keefe Bruyette Bank Index, which includes a lot of those regional banks. And what's amazing here is really how little it's come off the bottom, that horrendous bottom in March. And it's come back. And you can see just a little pullback here in the last couple of days. Ken, we got to do a data check as well. Let's do currencies. Haven't done much today on that. Dollar weaker by a good 0.4% on DXY, 78.06. Dollar yen 92.43. Euro dollar $1.4335. Euro yen 132.48. A little bit of give back in that strong yen of the last few days. Sterling $1.6387. And Ken, I mentioned earlier, gold $686 an ounce. 2 big days up in a row.
Stock market futures. The highest level we've seen here in the past few hours. S&P futures up 8. Futures on the Dow up 64. Fair value indicating the S&P up 0.8%. The Dow up 0.7 when the bell rings at the NYSE in an hour and 15 minutes. That follows word from the European Central Bank that they're going to stand pat on interest rates. 10-year Treasuries down 11, yielding 3.35 according to BG Cantor market data. The 2-year at 0.93. T-bills back below 0.13. They're at 0.1298%. This is Bloomberg Surveillance.
The dollar and the yen this morning. That's after the European Central Bank kept its benchmark interest rate at a record low of 1% today. That's a Bloomberg Business Flash. Ken, Tom?
Vonnie Quinn, thanks so much. Julia Coronado with us from BNP Paribas, the pride of the University of Texas at Austin. Also, John Riding, our guest host. Let's talk Fed policy in all that's going on. I don't want to get into the Bernanke thing and all that. Long ago and far away, John Riding did an essay, a note, about the putting green being moved out. Like the Fed was going down the fairway, and they just kept extending. it was a measured putting green.
Well, they were putting from the tee. That was the problem when they started trying to exit from a 1% funds rate. And this time they've no interest in getting on the golf course.
Where are we on the golf course? That was my question, Julie. Where
I would agree.
Right now?
We're still in the club having drinks. So
well, that's good. We like that.
Yeah, I don't think that they're even considering raising rates for a good long time. I think the market's a little bit ahead of itself there.
Is there a change behavior at the Fed when they get back out on the golf course? Are they going to get out there in a less measured way?
I think so to a degree. I think it's, that Chairman Bernanke does understand some of the lessons learned. That said, it's always easier to say than to do. It's much harder to raise rates, especially if we're in a subpar recovery like we expect.
Well, I'd like to see some addressing of the balance sheet size before the rates issue. I mean, the problem is right now, if they continue to grow the mortgage portfolio the way they plan, if TALF continues to grow out, they're still going to add more than $1 trillion to the Fed balance sheet. And one of the things you're supposed to do when you're in a hole is stop digging. That's
$3 trillion? You're saying?
Unless they wind up the mortgage program early or TALF take-up peters out, there's another $1 trillion at least to go on the balance sheet. Because it's been held down because all of the short-run programs, like foreign central bank swaps, have been rolling off. Mm-hmm. But they've been adding these permanent programs, long-dated programs, and when the short-run programs can't roll off anymore, the balance sheet's going to expand.
Julia, when we were talking about commercial real estate before and problems of regional banks, the message seemed to be is that if banks consolidate and I can pick the right ones, then I'll do pretty well, the targets. And the other thing you were saying is that if you're a vulture investor, there are going to be plenty of real estate deals around. Can we narrow that down a little bit? Where should we start to look?
In terms of sectors or regional bank names, I wouldn't have the expertise to call that. But I would agree. Every crisis is an opportunity for somebody, and we're seeing that right now in the housing market. We'll definitely see that in the commercial real estate and the banking market. So, yeah, there's going to be opportunity there.
I've mentioned before that there's an old movie called The Money Pit, where one of the characters says you're taking advantage of someone else's misfortune. That's the basis of real estate.
Yeah.
So we're in another one of those periods here, Absolutely. I guess, if you can get the credit.
If you can get the credit. So cash is king. So those people that have the cash will be able to make the most of this situation.
Just because of time, where's the unemployment rate going to?
We think it's going to hit close to 11%.
Well, I wish we had more time to talk. Really, what's the velocity to 11%? Is it...
I think we peak in the spring of 2010, and then we stabilize and start moving down from there.
11?
I'm going closer to 10. I think to get to 11, that's a pretty rapid, use your word, velocity. My problem is not the peak rate we get to, whether it's 10 or it's 11. My problem is that you don't see the growth that's going to get that down. So we're talking about a third jobless recovery. But the last two were from relatively low unemployment rates. The unemployment rate peaked 6.3, 6.4% in the last recession. If this one's going to peak at 10 or if it's going to peak at 11, and we're only going to get 2-3% GDP growth, we're going to see elevated unemployment levels for a long time. And ultimately, that's going to be unacceptable. But I don't know what Washington is going to be able to do about it.
Well, let's do a data check here. Julia Coronado, thank you so much for coming in.
It's my pleasure,
Julia.
Tom.
Great to have your congratulations on this new position. Are you learning French?
Not yet, but I'll try.
Okay, you and I, we can talk about a misery index, you and me trying to learn French. Julia Coronado, thank you so much. And John Riding at one point was learning Japanese. How did that go?
I have some French, I have some Japanese, but I'm still here in New York.